Welcome to the What to Watch video update. This is the last video that I do each week. I do a video every day. I do a weekly video, intermarket analysis video, a thing I call the deep dive video. And then I put together this video, and this is focused on what areas are we watching. Now, when I initially set out to do this video, it was going to be updated on an as needed basis, but it's evolved into a weekly video with the other videos that I do. And what I do is I look through all of the charts. I pick out those that have some positive aspects, some that have some negative aspects. And these are the things that we're watching as the week unfolds to see the whole story as things play out in the stock market. Before I get going into that, I do have a program. It's currently free right now. And that's pretty much because of a potentially upcoming trip. Actually, the trip's not potential. Whether it's going to happen or not is what's potential, because it'll be to the Middle East, which is where they have a lot of unsettled things right now. And I'm not sure if traveling there will be a good thing. But in the meantime, you can go to a link that's below this video to the spxinvesting.com website. And there's additional videos that I post there and additional information. So feel free to check that out. Also, as I mentioned just a moment ago, the daily video is the real foundation of the analysis that I do. If you just watch one of these outside videos, and I know my videos are longer, but hey, you want to be successful in the market, it takes more dedication. You really need to focus on the daily video that I do from my perspective. All of these other videos, including this one right now, are just meant to supplement the daily videos. Okay, let's go through and look at some things that are positive. Now, it depends on how you look at these charts. You could look at this same chart and come to a negative conclusion. There are some negative things that'll be here in the positive list, but I like to keep these groups of charts together. Okay, so first of all, now we're going down right now. You could look at this chart and go, what in the world is positive about this? Well, when I look at this chart, I like the fact that the red line, even though they're on different scales, that's the the NYSE advanced decline line. It's sticking pretty much to the S&P 500 now. And you can see other times when they get disconnected from each other, sometimes it's more positive, sometimes it's more negative. But the idea that they're going more in lockstep right now, to me, I'm taking that as positive. But on the other hand, you could look at this chart and go, yeah, we're going down. And we might drop below the 50-day moving average when we measure the NYSE advanced decline line. So there's also a negative thing that you could take from this chart. And that's the thing when you look at charts. You could have 10 different people looking at the same chart and they could reach 10 different conclusions. That's why I use what's called the consensus approach, where we look at lots of different things to say, okay, what is the big story going on here? What is the weight of the evidence actually telling us, instead of just looking at one chart and going, oh, now I got it all figured out here. Okay, another chart that is still positive for right now, even though it is coming down, is the 10-day average of the S&P 500 highs minus the lows. Okay, this is more longer short term, even a little bit intermediate term. When this is really up high, we use this like an oscillator, and it just suggests that, okay, the momentum is clearly positive. It's still positive. It's above this green line, but it is coming down. Now, if we fall below this green line, that'll turn it more negative. But for right now, it's still hanging in there positive. Another thing is we take a daily score of the new highs minus the new lows for the S&P, and we're still coming up with a positive score here. Okay, so that's positive in and of itself. And then down below is a 50-period moving average of this score on top. Now we are starting to tick down just a little bit, but for the most part, this has been going up. If this starts to turn and continue to go down, obviously that would turn this chart more negative. Then here's another way of looking at that same idea, just a different perspective, because sometimes with different charts, you look at it with a slightly different time frame, or you move things around a little bit and you see things that you didn't necessarily see before. We're just ticking down a little bit here, but we're above zero, so we're positive, and we've been positive for a while. And for right now, this is holding up, but this could switch over negative if we see more weakness in the S&P. Then we look at the broad market, the Amex, the NASDAQ, and NYSE, and take a 5-period moving average of the highs minus the lows. Even though we're coming down, we're still positive. And this is what seems to be more encouraging right now, is that the broad market, as represented specifically by the NYSE, is holding up better than the rest of the market. And other parts of the S&P 500 are holding up better than the mega caps and the large caps. Unfortunately, it's the mega caps and large caps which really drive the price of the indexes. So we might be holding up better throughout the rest of the S&P 500, but if those stocks are really seeing some weakness, that could really drive prices lower. Then this is also positive now. We are coming down, the bullish percent index. This measures the point and figure buy or sell signals inside of the S&P. Even though we're coming down a little bit, we're still well above 50 and we had been declining. With the decline that we're seeing in the index itself, the fact that this is coming down, okay, we have to respect that it is declining, but it's not coming down really all that fast, at least right now. If this starts to really accelerate to the downside, that would turn it more negative. But for right now, this is leaning more on the positive side. And we also look at the NYSE bullish percent index coming down a little bit, but still above 50. That means the broader market is still hanging in there for the time being. Now, this one is negative because we've dropped below 50. This is the NASDAQ 100 bullish percent index. And I like to keep the bullish percent index charts together. That's why, even though we haven't, this is the positive section, this is a negative slide, but we've dropped down below 50. And this is just showing how the mega caps, the large caps are really not holding up right now. And if they continue to show more weakness, that's going to put pressure on the NASDAQ 100 as well as the S&P 500. Then here's the new highs minus the new lows for the NYSE. Now we're holding up okay with the S&P. We're also holding up okay here with the NYSE. Now this could change at any time, but for right now, it's hanging in there positive. And here is a cumulative NYSE advanced decline line based on price. Yeah, it's coming down because we had a down day on Friday. But if you look at this, it's rolling over, but it's still above an advancing moving average. So it's showing some weakness, but holding up for right now. Here's another measure of a different NYSE advanced decline line that's calculated in a slightly different way. Also coming down, but still above an advancing moving average. Then we look at common stock based on price. We're coming down. Common stock based on volume. So what in the world's positive about this? Well, when we compare this to what's happening with price and volume for the S&P, volume is going down a lot quicker. Where when we look at this, okay, they are declining, and that could be negative, but they're more in lockstep with each other for right now. And so we're not seeing that thrust of volume to the downside with the broader market, at least yet. And we'll be watching to see if this changes. Then here's the new highs, new lows, just the raw score for the NYSE. Even though we've been pulling back, we're still positive here. The advanced decline line, yeah, showing some weakness right now, but we're still above the moving averages for the NYSE, the S&P. The mid caps are coming close to the moving average. Now the small caps are a little bit more negative. They've dropped below the moving average here, but the one I focus on the most is the S&P 500. The Dow set an all-time high just a little over a week ago. It has been declining, but it's still above its 50-day moving average. That's why this is considered to be positive. And the financial sector pulled back both on Thursday and Friday, but this has been one of the stronger sectors lately. And so we can take some encouragement from that. If the economy was getting ready to fall apart, if there was a lot of concerns about what's happening with the big banks and the small banks and the regional banks and all of that, this sector would not be holding up the way it is. Now that's the positive side. The reality side is, if you go all the way back to 2007, this was also holding up well right before we went into the great financial crisis. So yeah, it's looking pretty good for the time being. This is why we watch this, to see if there's any clues as to what's happening where things may be shifting over more negative. And then we do a ratio between the financials and the S&P. And you can see the financials are really beginning to outperform here. And we're about ready to see a golden cross with this ratio. And they're holding up, financials anyway, are holding up quite well. Longer term, a weekly chart here. This is a trend line going all the way back to the 1987 crash. This is long-term support, and we're still well above this, even though we've been coming down. Then we do a ratio between the Qs and the small caps. Now, the perma bears are out there saying we were going to come up here, hit this, turn and go, and everything was just going to blow up as far as the stock market was concerned. Well, that really hasn't happened yet based on this chart. And the person I got the idea from this chart from, they're focusing their whole scenario, their whole thesis on this chart. And it's been quite disappointing. That's why you've got to use as much information out there as you can to reach your conclusions, because it doesn't always tell you exactly. You might have confirmation bias where you look at a chart and you're like, okay, I look at this and it's negative because it's below the blue line. Somebody else could look at this and say it's positive because we're still near the blue line. Okay. That's why we use technical analysis and we try to remove as much emotion as possible. And how do you remove emotion? By replacing it with facts and replacing it with unemotional bits of information that you can put together into a big picture. Then we look at the NASDAQ 100 and the Dow also coming down, but still at this very high level. And now, typically, what we associate with being positive are interest rates going down. And that's what's been happening. The 10-year bond yield has been coming down here. But you notice the bar that we saw for Friday? We opened, had a high, a low, and then a close. And we closed just about at the same point. Does that suggest maybe some kind of a reversal? We don't know. We'll have to see how things play out. But for the most part, as interest rates have been coming down, that is more positive, even though stocks have been under pressure lately too. Then we look at the 1 to 3 month T-bill, which is cash, and we compare it with 3 to 7 year bonds. Now, I added the question here. You can look at this chart and go, yeah, it's positive. This is negative. As a general rule, when this is going up, that means there's more uncertainty about interest rates and inflation. Well, we started to come down here. But what is the context for why we're coming down? That's what the market is trying to figure out right now. If we were coming down and we still had inflation under control and we still had interest rates declining and stock prices with the ability to go up and the Fed coming in and cutting rates, and it's to stimulate the economy, this going down would be more positive. But we saw the employment situation report come out on Friday, and it didn't really disappoint. Market still sold off, and they were just looking for an excuse to sell off. And we were seeing that building up before Friday's session. But if the Fed comes in and cuts rates because the economy's falling apart, that's a whole different context. And that means stocks are going to go down too. Where if they're coming in to just kind of fine tune the economy and help it grow a little bit better, that could be positive for stocks. So that's why we want to know the context of why is this going down? Now, for the last few years, this coming down has been positive because we've been seeing the economic reports for the most part showing that inflation is coming down, but the economy's not falling apart. If we start to see weaker than expected economic reports, and this is going down because of that, that changes the whole scenario of what we've been watching lately. So again, that's why we want to keep an eye on this. Then we do that same basic approach here, but we look at different maturities of bonds, 1 to 3 year bonds compared to 3 to 7 year bonds. Now it's falling. What is the context? For right now, this going down could be positive for stocks. But if we're seeing economic weakness starting to come into the picture, this going down could actually be negative for stocks. Another context type chart here. We look at TIPS, which are Treasury inflation protected securities. When these are going up, like we saw back in 2021 into 2022, and comparing it to 7 to 10 year bonds, that means there are inflation and interest rate concerns. Well, this coming down, excuse me, this coming down means that those concerns are going away, but are those worries being replaced by another worry that could continue to see this going down, but is more negative for stocks? That's why we pay attention to all this stuff, to see if the context is changing. All right, then we look at the negative side, and we've got quite a list of negative things right now. A week ago when I did this video, we were more positive because we were above 50 and going up. Folks were feeling pretty good about things. Now we've dropped below 50 and we're going down, so we're more pessimistic when you look at the fear and greed index. So this is switched over to negative. Also, this is negative because we dropped below the 50-period moving average. Now, as the week unfolded, we were camped out right along the 50-day moving average. After Wednesday, after Thursday, it was acting as support even after Tuesday. Well, it gave it up on Friday and we closed below that. And that's why this is on the negative side right now, because we're breaking below intermediate term support. Now, I don't have it on here, but there's a 20-period moving average, which was just about on top of the 50. And the fact that we closed down below it means in the short and intermediate term, we've switched over to negative. And also, if you look at the bottom, you notice the days that we're going down, that's when we see above average volume. Okay. Then this is put out by Tom Bowley at stockcharts.com. We're up into that range now. We're above 20. We closed at 22.38 after Friday's session. This is a weekly chart of the VIX. And we're up in this area where we tend to see negative annualized returns for stocks. And that's the VIX going up is pressuring stocks, or there's more fear in the market. And so people are more inclined to sell. Here's another look at the VIX climbing right now. When we look at the closing value with the line chart and also going up with the bar chart, and the VIX of the VIX going up as well. This is the volatility of the VIX. And this picks up when the VIX picks up as well. And the momentum of the VIX is now switched back over and is going up as measured by the MACD. Now, this is a variation on the VIX. And we're still in this red area. We spent a lot of this week in the red area only to go more up into it. We came down on Friday, but we're still in this red area where the market is still anticipating more move yet to come. And based on the context of what's happening, that could likely be to the downside. So we're going to keep watching this until this drops below this red area. And then we look at the growth to value ratios intraday. This is not very positive right now because the red line's above the blue line, and they're both declining, so they're both negative. But we want to see the blue line above the red line, and that's not happening. Another thing, when we go back to about the 20th or so of August, that's when we started to top out on the intraday chart with the growth to value for the S&P. This has been declining ever since, and that is putting some pressure on the market. Here's an end of day chart showing small cap growth to value going down for the most part, not positive for the market. Mid cap growth to value declining, not positive. And we're coming back down here with S&P growth to value, not positive for the market. We want to see these growth to value ratios going up to see the indexes have a chance of going up. Then we look at a growth ETF and a value ETF. We're coming down below the rainbow, and this is showing some real weakness right now, not what we want to see in a more positive environment. And we look at some other growth to value ratios. The Qs to S&P, down. We had been showing a little bit of improvement here with discretionary to S&P, even though it ticked down a little bit. So this is actually a little bit positive for right now. But when we compare large cap growth with large cap value, we are now declining. So with the large caps, mid caps, we ticked up a little bit, but we're still declining with the small caps. Not really seeing any strength right here now. And we look at discretionary versus staples, also declining, even though it's still in a longer term uptrend. The blue line's above the red line here, but it had been going back up. Now it's starting to go back down, and that's more negative for the market too. We look at the risk on versus risk off ratio, declining now as folks are getting out of the high flying stocks, the Nvidias, the Googles, the Apples, and getting into more conservative stocks, because there are money managers out there that they have to be invested all the time. They don't have the luxury like you or I have as individual investors to drop on over into cash. They have a mandate if they're a hedge fund, or they have a prospectus if they're a mutual fund, where they have to be fully invested. And so it's like, okay, now I need to find stocks that'll do the least damage. So I'm going to get out of the high beta stocks, which tend to outperform on the way up, but they also go down faster on the way down. And I'm going to get more into conservative stocks, stocks that tend to hold up better when we see a decline. And when that happens, that's when we see this ratio going down. Then this is still positive in one way, but also negative. It's negative because we're going down based on price and volume. It's still positive with the advanced decline line here because we're above an advancing moving average. So that's holding up for right now. We're going to be watching this. If we see more weakness and we really drop down to this moving average, that's going to turn things quite a bit more negative. Also, the new highs, new lows, another internal measure that we look at. Dropping off with the new highs, seeing a bit of an expansion with the new lows. So we're rolling over with the 5-day and the 10-day now. But for the most part, we're still seeing an awful lot of green when compared to red. And as long as this holds up for the time being, this internal measure is still looking okay. But if we see the red really start to expand and the green really contract, that's when things are going to turn more negative than they already are. The advanced decline ratio, you could take this as positive because we're above zero, but we're really declining, especially in the short term here. And if we have any more weakness, we're probably going to drop below this midpoint. This is another look at the 19-day advanced decline ratio, where we're coming close down to the zero line based on price, but we've already dropped below zero here based on volume. So that's a little more negative that way. This is accumulation distribution, a smart money indicator. It takes price and volume into account. We've dropped below the red moving average here. Now, what I've done, I have this thing called a boom indicator that tries to measure how far above or below we are from the moving average. And it's not quite a true representation. This is really just a manipulated MACD indicator, but we are dropping below the moving average. So this has actually gone from positive. Now it's over to negative. And we're starting to turn down here with the Chaikin money flow, another smart money indicator. The red line's starting to roll over. The histogram is starting to go down. It'll be full-blown negative if we drop below zero and actually turn to red. And Chaikin oscillator is negative now. We're below zero and declining. The vortex crossed over negative this past week. We saw the red line going above the green line, another primary indicator that has now turned negative. Now, we're keeping an eye on the trend because we've not been trending lately. And this is, if you were to tell me you could only have one chart, it would be this chart, the ADX, but it would actually be the next chart after this based on the intermediate term. Well, I wanted to bring up the short-term chart here because we're starting to turn up and cross above the moving average. I know there's a jumble of lines over here, but this just suggests that the trend is starting to get stronger. Now, we use the static number of 20, and we're still below that, meaning that we're not trending yet. If we get above the moving average, that means the trend is developing. If we get above 20, that means it's a confirmed trend. And then we look at what line is on top. Well, the red line is above the green line here, so that means we now default to negative. We did see a cross here from positive to negative and a potentially the beginning of a strengthening trend, which could be more negative for the S&P. Then this is the chart that I really focus on the most. And we never really did break out here. We were going sideways, and now we've started to fall down. We're turning up here, but we haven't crossed above the moving average yet. And the red line's on top and going up. So this is suggesting that there could be more of a negative trend being developed. All right, and we are declining with the 20, 50, and 200-day moving averages here. These are just on the S&P itself. And we look at the S&P 500 advanced decline line on a cumulative basis based on price coming down. This is one of the concerns. You see how we're going down with a little bit more velocity based on volume? That's not real comforting. Where it's holding up a bit better when we look at the NYSE. Now we look at the 20-period moving average. We held on to it until Friday. We broke below it and closed down below it. So now the short-term trend is negative, and we went down pretty fast here. And this measures how far above or below are we from the 20-period moving average. When we get down here to this negative reading, that means we've become too far away. And the moving average tends to act like a magnet, or you get so far away from it, and then you go boom back to that moving average itself. And that just suggests that maybe we've gone down kind of far, a little too fast. We're dropping below zero when we measure the distance away from the 50-period moving average. That's looking negative. We're declining, but still positive with the distance away from the 200-period moving average. Then this is a rainbow chart, and I usually only show these in the deep dive video, but we've dropped below the rainbow. This is a set of moving averages from 10 periods up to 50 periods. And the fact that we're dropping down below this is turning the short-term trend more negative. And if we stay down below this and the lines start to roll over, that would be more negative as well. And we keep an eye on the 50-period moving average. This was the real focal point until after Friday. You see how we camped out right along here, and then we dropped down below that. So this is intermediate term. The trend has now switched over to negative, and we've lost that level of support. Now we're focusing on the 100, which is kind of intermediate to somewhat long-term here. The 200-day is really the long-term moving average that I focus on. We're still above this level here. Are we going to be able to hold on to that if we see more weakness? Here's an intermediate term rainbow chart coming down, but we haven't fallen below the actual rainbow itself. And this goes from 50 periods up to 100 periods for the moving averages. And we put all the moving averages here together. The 20 and the 50s are now in the rear view mirror. Right ahead is the 100-period moving averages. If we break below that, the moving average that I'll be focusing on will be the 200 simple and exponential moving averages. Okay, and then we're turning negative here with the S&P McClellan oscillator. It's dropped below zero and declining, and not necessarily extreme, at least yet. So when that goes down, we're rolling over with the summation index based on price, and we were already going down based on volume. We were seeing a negative divergence there. Now they're confirming each other to the downside. Here's the NYSE McClellan oscillator, holding up better, but still also starting to turn negative because it's dropped below zero. And so the summation index based on price for the NYSE is going down, as well as volume. And the Swenlin trading oscillator, we were holding up better based on price. We were looking more negative based on volume. Now we're seeing more of a confirmation. We dropped below zero based on price and volume and continue to decline. And the parabolic SAR is still negative here. Now, if you watch the weekly video, the weekly chart is still positive, but here on the daily chart, we continue to be negative. And the momentum, we're shifting over and going down in the short term, intermediate term, and we're rolling over, but haven't quite crossed over negative in the long term. RSI coming and dropping below 50, both with the 14 period and the 9 period. And you could, as I've been pointing out in the daily video, where we made a really high reading here, and then we were going back up, not quite to previous prices, but we were making a lower high. Now, some of this is the way the indicator's actually calculated, okay, because it uses back data to do this. And so you could say, oh, I have a high here and a lower high here. Oh, that's a negative divergence. Yeah, and that is, but some of it is more mathematical than it is actually what's going on necessarily. And so it ends up being more of a self-fulfilling prophecy because lots of people see this at the same time. But as long as we drop below 50, that suggests that the momentum is now turning more negative, both in the short term of the 9 period and intermediate term with the 14 period. And the Ichimoku cloud, we're starting to drop below this green cloud here. Now, we're also positive because the blue line's above the red line, but the blue line's really coming down with a vengeance right now. And it's really hard to see, but the green line is also coming down. So if we continue to fall out of the cloud and the blue line crosses below the red line and the green line continues to fall, that's going to turn things more negative. And this is a weekly chart of the S&P. We had been hanging on to this R2 pivot point. Well, we dropped below that, and that's pretty significant longer-term support that was lost. And we look at those stocks above the S&P, or in the S&P above their 20-period moving averages. I was pointing out a week ago, this was just screaming high. Well, we're really falling down. We've actually turned negative now as we've dropped below 50. And we're also declining, but still positive with those stocks above their 50-day moving average, declining with those above their 100, and also declining, but still positive with those above their 200-day moving averages. Then the S&P to utilities ratio, we want this to be going up to be more positive for the S&P. Now it's going down. Staples, we want this to be going down, and it's going up. Staples are outperforming the S&P right now, and that's more of a defensive posture that the market might be taking. And the mass index, this was triggered, my goodness, it actually kicked off about halfway through August and then it just didn't do anything. And this suggests that there'll be a reversal. And we were going up when this was all triggered, and now we're going down. So maybe this is legitimate after all, but we don't know that until we actually look back and use hindsight to evaluate this. So this is not one of those indicators I like to use alone. We look at the S&P and then take a ratio of the equal weight. The fact that this is going down means that the large caps and the mega caps are underperforming. And here's another take on Dow theory, where instead of using the Dow, sometimes we swap that out for the S&P. Well, instead of using the S&P, why not use the S&P equal weight? This is coming off of just setting an all-time high just a little over a week ago. And yeah, we're pulling back right now. But what's concerning about this chart is look at the QQQ equal weight, where we swap that out in place of the transports. This is actually coming down to these previous highs and going down with a lot more velocity. And that's a little bit of a concern to us. The NASDAQ dropping below the moving averages, below the pivot points. Are we going to come down to the 200-day moving average? That's what we're watching for here. And what's interesting about this is the 200-day moving average and this S1 pivot point, they're right at the same point. So if we come down, that could be some really good support. If we break through it, that could be pretty stinking negative. And we're seeing a very similar thing here, even though we're a little bit above this pivot point with the NASDAQ 100. Are we going to come down and try out the 200-day moving average? The momentum for the NASDAQ 100 is negative, and we're dropping below all the moving averages here with the QQQs, which is the ETF for the NASDAQ 100. Small caps. Now, before Friday, I actually picked this out as a thing that I was watching because the small caps came down to their 50-day moving average, and we had some other indexes that were also at their 50-day moving average that could have provided legitimate, really solid support. Well, that was lost on Friday, and we've fallen below the 50-day moving average, even though this is still in a longer-term uptrend. We look at the Russell 2000 small caps, where we also fell below the 50-day moving average, but we're in a longer-term uptrend. As far as the RSI going below 50 and declining, and the momentum is also negative. And then we look at a ratio between the small caps and the S&P. These were really starting to break out, showing the small caps were improving. Not right now. They continue to really underperform the S&P. Mid caps falling below their 50-day moving average and declining. So that's more negative there. This is what I was watching before Friday. We were right at the 50-day moving average, and I was pointing this out in a daily video. It'd be nice if we could bounce up off of that and stay more positive. Nope, we fell down below this, and this is a broad market measure. The same thing I was watching on Friday here with the total US stock ETF, right at its 50-day moving average, but now we've fallen down below it, and that's more negative in a broader sense. The FANG index is declining, but it's below its 50-day moving average, but still above its 200-day moving average. When we had the big dump in early August here, we came down to the 200-day moving average here. That's why we're going to be watching this. If we see more weakness, will the 200-day moving average provide support? And we've already broken support here with this shorter term trend line and a little longer term trend line. And there's really no place else to put a trend line for right now. And I try to stick with the rules because you can draw whatever trend line you want on here and say whatever you want a chart to say. But I don't really see a point to really draw that unless you go from here to here. And now you're way off over here, which is pretty much irrelevant right now. We look at the staples to tech ratio, and this is going down. That means tech's outperforming. But now look what's happening. The staples are outperforming tech to the point where we might be seeing a golden cross here with this ratio. And that is more defensive for the market. We'll look at large cap growth. Fell down below its 100-day moving average. Is it going to come all the way down to its 200-day moving average? And we look at small caps to tech. This is starting to bounce back up as we're seeing more weakness in the tech sector. Then everybody, not everybody, because most people don't even know about this, but the 10 to the 2 yield curve, or a lot of people know about it, but they don't really understand it. This went back after over 2 years now. We finally got a close back being uninverted or going back to regular. When this goes inverted, that means that the 2-year yield is actually paying a higher yield than the 10-year. Well, this just means that things are switching more back to normal. Now, you're probably going to hear, and you probably maybe even concluded yourself, that this is the countdown for stocks to crash. And that may happen. But we just want to watch this play out and see how things develop. Is it going to be able to stay inverted or uninverted here? We still have another yield curve, the 10 to the 3 month. It hasn't gone back to being uninverted yet. And this can be anywhere from a few months, 5 or 6 months on average, all the way out to a year before we actually go into a recession. And incidentally, on the website, I'm going to be doing an updated recession outlook video that members will have access to. All right, here is the 10 to the 3 month where it went inverted after the 10 to the 2. Well, it's going to become uninverted after the 10 to the 2 becomes uninverted here, where it's got a ways to go here to really show some improvement. And we look at, are we still going to have a soft landing, meaning no recession, or a hard landing, meaning there will be a recession? Well, the market's a little bit doubtful now, wondering if that's actually going to happen as we come into the rainbow with this ratio. This is an inverse of that same chart because we like to look at things from a different perspective. And this is showing how bonds are really outperforming recently stocks. And if we continue to go up, that would be more negative for stocks. And we look at the S&P 1500 and compare it to 1 to 3 year treasury bonds coming back down into the rainbow. Broad market with 3 to 7 year bonds coming into the rainbow here. The tech sector to 3 to 7 year bonds dropping below the rainbow now as the tech sector is seeing more weakness. The QQQs, another tech area, 3 to 7 year bonds, this could be critical. We're coming down to the 250 period moving average here. Now, we held at this level before and we're able to bounce up off of that. Are we going to break through it? Or are we going to find support here and be able to bounce up again this time? Euro stocks, just those stocks in the Eurozone, also coming down to the 250-day moving average when compared to 3 to 7 year American bonds. And home construction, this is actually holding up okay. We're coming down with everything else, but we're still at the top end of the rainbow here. Here's a long-term rainbow coming into the rainbow. Even with the big dip that we saw in early August, it kind of made some of the shorter term lines flutter a little bit. But if we continue to go down, this will turn more negative. And this is why we can still say the long-term trend is positive. And then we want to keep an eye on this. The spread between risky and not as risky bonds, we want this to go up. That means the market is perceiving less risk. If this really continues to go down, that means there's more risk. And we're starting to drop underneath this trend line with the NASDAQ 100 weekly chart going back to 2009. That's more negative. And we take a ratio between the semiconductors and the Dow. This is showing some weakness right now. And then there's a thing called the Hindenburg-Ullman, and the perma bears love this thing. And be aware, though, because there's some perma bears that I kind of lightly pay attention to. I just glance over their spam emails. And they're already declaring that a new Hindenburg-Ullman has been generated. No, it hasn't. We've seen the first part of it being generated. We have yet to see a confirmation. So if you want to learn more about this, you can pause this and just read through this. But stockcharts.com has this thing where they've taken the 3 criteria of Hindenburg-Ullman and put them together. And we had another spike up. Now, there's a 1-day lag when this chart is actually updated. So it was actually on Thursday when we had this spike up. What needs to happen? Between September 5th and October 3rd, that's 20 trading days, there has to be another spike up. That's when you get a confirmed Hindenburg-Ullman. So if you're, at least according to this chart, and this is the S&P on top and the NYSE Hindenburg-Ullman indicator down below. We're not getting one for the NASDAQ right now. But if some of the perma bears try to convince you that, oh boy, salivate, sell, 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 go short, there's no confirmation for that yet based on what we're seeing here in this chart. Okay, another thing that we want to keep an eye on, because the employment situation report was a bit disappointing, but on Thursday we had weekly jobless claims that are actually going down. So that was better than expected. So you can see why the market's a little confused. And this is putting it all into perspective here, where we see the red line, which are initial claims, the blue line are continuing claims. Then we have the unemployment rate, which ticked from 4.3 to 4.2%. This is what the politicians love. They're like, hey, under me, unemployment went down. Vote for me, vote for me. This is a very manipulated number. And so I personally don't pay a lot of attention to it, but a lot of people do. And it can really make some noise in the market. So we want to be watching it as well. Another area that's, again, you could say more defensive, because usually when utilities are really going up, that's when the market's getting ready to go down. And that's what we're seeing when we look at this all by itself. Now, there's another side to that argument because we have EVs, because of all this crypto mining, and because we're doing away with dams and hydroelectric power and switching over to this green garbage. This is really going up. Maybe because of that. And maybe utilities are becoming more of a growth area. Okay. But at the same time, when utilities go up, that also means the market is getting more defensive. And we do a ratio between utilities and the S&P, how utilities continue to outperform. Staples, also another defensive area. Think of toilet paper and toothpaste. This is really going up. That's usually not what you see when the market's more in a growth mode. This is more defensive, usually. And when we compare the staples to S&P, really seeing a move up here. And this is similar to what happened at the end of 2021. Now, we've seen some false starts before, and this could all rectify itself, but we just want to be watching this for right now. And then we look at the SPY to staples ratio. Well, the SPY is really underperforming. And we can kind of look back here. You see where it was doing good at the end of 2021, and then it fell apart. And then everything started to roll over here. Well, the interesting thing about this is you notice how we started to roll over and the moving averages started to crumble. We set the high in early 2022. This was rolling over in about the middle part of December 2021. So this gave us a couple of weeks heads up that things were really starting to fall apart. So we want to keep an eye on this. If we keep going down and these lines keep rolling over, yeah, it may give us a bit of a heads up before things really start to hit the fan, if that's ends up being what happens. Healthcare, another defensive area, coming down last couple of days, but setting all-time highs here just as of Wednesday, and really looking much improved. Still in a downtrend compared to the S&P, but really coming up. And because you have to have healthcare no matter what's going on with the economy. We want to keep an eye on oil. It's really dropping right now. What we're watching for is if it really spikes up because of geopolitical unrest in the Middle East. And the dollar is in a downtrend. Now, this could actually be more positive for stocks since they like a weaker dollar. And it's switched over to a downtrend here on the daily chart as well as the weekly chart. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. You'll get better context that way. But I hope you're having a really nice weekend, and I will talk to you in the next video.